This has been a great event so far, and I'm really excited to have everybody here. And I'm also excited about where we are today. And I want to cover something that is new. It's what's called structural change in power supply. And you've heard this term bantered about. You all know I'm a PhD economist, so I'm going to put it in the economic context of where we are, and more importantly, how this has implications for decision analysis. And underlying that decision analysis, what are the modeling precepts that we need to get right in order to capture structural change and why it's so important. So I do have a thesis for today's talk. It's real simple, and you've heard this again and again. Renewables are obviously entering the market at a kind of an inexorable rate, whether PTC, no PTC, they're here and are continuing to become a greater part of our energy supply. And moreover, we're seeing pronounced transformations in market prices. And I think this has resulted in a lot of financial pain for a lot of the wholesale generators. They're wondering what's happened in the last 3 years and what's going to happen in the next 3 years. And we've seen technological evolution, as Mark Dyson just said, like we've never seen before. Prices dropping of 20% plus per year or more, 50% for batteries. Solar last year came down by 30%. So this inexorable rise of renewables is having a pronounced impact on price formation. And that is the foundation for structural change. When we look at the human behavior in response to structural change, that's where there's a dynamic that we need to be aware of. And I'm pitting Jorma Olia against Steve Jobs. He's the CEO of Nokia, and Nokia's no more. Apple dominates the cell phone market. Is this where we are today, 2007? And we're at that crossroad. And the CEO of Nokia, who's obviously vanquished from what's called the disruptive technology of Apple, he was looking at his sales numbers. Are we going to meet next quarter's earnings? How are they? And totally lost sight of the broader picture and problem. And we just need to be aware of that. Except in utilities, things are moving a little slower, thank goodness, than in the world of cell phone technology. But they creep up on you very quickly, and the rate of change of technology is pronounced. So Olia said, we understand the problem, but at some deep level, we couldn't accept what was happening in 2007. Many big projects just carried on. We examined the sales projections for the following quarter, when our eyes should have been focused much further ahead. And so I want to bring your eyes further ahead and raise some consciousness and challenge where we've been, and particularly, this is a quant shop, Ascend Analytics, and the way we think is in terms of the numbers and how are we or are we not capturing the new market dynamics, and what do we need to do to prepare ourselves for tomorrow? How can we look better down the road, understanding the new fundamental drivers? And I think David Millar and I led a pre-conference workshop, and there's a section of that workshop called "This is not your boss's resource plan." Just because what your boss was doing was great back then, but the world is different. And this is the issue. It's like Nokia in 2007. If you don't get with the transformation that's undergoing, and particularly understanding the implications for decision analysis and how the tools that you have might not be fit necessarily, even our tools, we're adjusting quite rapidly to capture these new dynamics. So that's what I want to bring you through. First, I need to talk about structural change. So as an economist, we define structural change as a shift in the basic way markets function. All right, yeah, there's a change. The change is where? In supply, principally, but also in demand. I'll show you that in just a minute. The change in supply fundamentals are wind. There was, Mark cited $20 a megawatt hour. You should have been aware of the $13 megawatt hour by North Dakota. And solar contracts were seen just tipping below $30 a megawatt hour. This is unprecedented. And he talked about how there's this continuous technological improvement in renewables, keeping chipping away at production costs. Yes, gas is kicking coal's butt, as the other Mark said in the keynote yesterday, Mark Gabriel. But what's also happening is technological advancements, and that's the inexorable component. That's the rise that you just can't stop, and it's happening because technology is advancing and it's constantly clipping out traditional technologies, just like the iPhone eclipsed Nokia's flip phone. When we look at other dimensions, RMI, Mark Dyson was talking about distributed generation, the potential for that, and customer defection. And we're seeing that, and I'll show you in the next slide what's happened in Hawaii in this regard, and how this is encouraged. In New England, it's being encouraged. And we're seeing a new dynamic where there are bold plans in the cloudy Northeast states for 50% renewables between New York and New England. That's disruptive, and a lot of that will be distributed out there, which is a little bit different than it's been in the West. Well, how do we determine the structural change? As an econometrician, we look at the data. And all we want to see is we look at the pattern of time series of prices, and can we determine that there was some structural change, meaning a difference in the time series from a certain period, let's call it 2000 to 2015, and then from 2015 to 2016 and 17. Are we seeing some changes here? And can we determine what are the causes of the changes and that they're real? Is this just gas prices that are moving, or is there something more fundamental to the supply conditions? And we know it's the supply conditions, but there are two components. One is the change in market prices, which we look at normalized to gas prices, so it's changes in implied heat rates. The second thing that we want to look at is change in volatility of prices. And this is critical because we've always looked at market prices based on averages. That's how we think, average price. But a new paradigm has come about where uncertainty matters as much as the averages. And particularly if you want to capture some of the advantages of the changes in market structure and dynamics, you need to capture the value that you can extract from uncertainty. That's what Allison Weiss talked about with their batteries, is look, this volatility in price is worth something. If we want to look at change in demand, here's Hawaii Electric. This is structural change. The red is today, or 2014, and at the top, we start at 2006, and then go to 2009, 2012, and 2014. And you can see over the same week in June, what was load of 1,200 now is load of 1,000. But there's also been a big erosion during the daytime hours of energy consumption. The peak, 2012, 2014, is roughly the same. Obviously, it's significantly different over the same weeks in 2009 and 6. So there's structural change. It doesn't take a Chow type 2 test to determine that that's structural change. But the erosion of demand in Hawaii is something that Hawaii, well, is embracing. It's part of their strategic vision of going 100% renewable. They want their customers to adopt rooftop solar so long as it fits in a manner that is consistent with their, let's say, stable grid operations and strategic objectives. It's a change in business models. And that's what we're seeing is the capital was being deployed in different ways for utilities in order to enable this type of integration of renewables. So this reduction in demand, it's not that customers are getting very efficient with their electricity. They're just leaving the system with rooftop solar and cogeneration facilities for a lot of the large hotels. That's creating change, and it's pronounced. It almost gets a little scary when you look at this and you think, oh, there's a starting of a death spiral. There'll be so few customers and so much embedded costs. How's this going to work? Well, Hawaii's rapidly changing their rate structures. Even if you're defected, so to speak, you still are typically connected to the grid. And so the grid connection charges are being adjusted upwards to account for this behavioral dynamic. So I'm going to run through two markets pretty quickly. First one I'm going to talk about is California, and you've seen some of this material perhaps, and the second one is ERCOT. And ERCOT mirrors California in many ways, but there's some differences we want to talk about. Obviously, California has a lot of sun, and ERCOT has a lot of wind. And you've heard about the dock, and this is how I present it in real simple terms. We have the sun rising during the beginning of the day, and that creates a lot of solar insolation at peak hours. So the super peak prices, the max 8 hours of the day, we've seen the prices from 2014 at $47 a megawatt hour drop to 2016 of $36 a megawatt hour. That's a pronounced drop. If we look at the implied heat rates, which is saying, hey, is this a function of gas prices or is this just the sun coming up? And you can see here that the implied heat rates were at, looks like about 10, and now they're at about 8 for the same hours. So a significant drop in implied heat rates during the super peak hours. So it's not gas, it's the fact that there's a lot more solar generation, and it's increasing every year. The effect is becoming larger and larger. The concern in California has been this rise in, when the sun sets, and meeting that, the duck, the ramp. That's something to look at. That's not where the opportunity lies. That's not where the risks lie either. And that's what we have to show you. The implied heat rates, though, do foretell something that is interesting. They are looking at, during the shoulder hours, roughly hours 18 through 21, we're seeing implied heat rates in 2014 of about 14. When we hit 2016 for the same hours, we're upwards of close to 18. So while we're dropping during the super peak, our shoulder hours are increasing. And we see the same thing in the morning. So it isn't overall a complete drop in prices. Yes, average prices are declining. There's no question about that. But we're also seeing a rise in prices during hours where there isn't a lot of renewable generation. That's average. There's nothing average about the weather. We know that. We live, we experience it. I mean, last year in California, there was, Wes, you talked about it, a lot of rain. And boy, nobody forecasted that rain very well, did they, from what you showed us. And not only that, you showed us yesterday that not only is there variability in meteorology, but according to the data you have, the variability is increasing. So we're living under a world with variable meteorology that's getting more variable. Well, how does that show up in terms of prices? That's what we want to look at. So the fundamental drivers are shifted supply stack, and that's shifting to the right, creating lower cost prices, but also because of intermittency, at times creating higher prices. Well, let's look at that. So this is San Diego. It's just a node in California. I have fairly old data, 14 to 15. I'm just zooming in here on a day. And the orange is the real-time price. The green is the day-ahead price. On average, for this node, the green is greater than the orange by about 6.5%. Let me just drag this across, though, through time. See if I can do this. Here we go. Oops. Try it once again. Okay. And you can see the prices going below zero and hitting $600 on May 27th, or close to it, and then dropping below zero select hours for the real time. It's extremely volatile. And this is just a typical node in Southern California, really no different in its volatility than any other node. It's wild dynamics of negative and positive prices. And this is in 2014, actually. So we have a variability that we've never seen before. Negative prices, positive prices. How does that impact our decision analysis? What do our generators dispatch to? In the end, Everything's settled against that real-time price. Now you may make transactions, and presumably do, to help insulate yourself against this type of volatility in the real-time market through the day-ahead market. But all renewables are settled against the real-time prices. That's what they receive by decree in California. Yeah, you can add a battery and enable yourself to receive the day-ahead prices, roughly a 6.5% premium. But that's different. Everything's settled effectively against those real-time prices. So how do your resources respond and realize the value, not that smooth green day-ahead line, but where the rubber hits the road in the real time? Yes, you can act on the green line for both load and generation, but you're taking a risk or perhaps realizing some upside in doing the day-ahead market. The real time is where the real charges are at. So back to the presentation. And I'm going to go a little quicker here. You've all seen this, I think, perhaps by now. We're looking at historically, renewables are at 7% 3 years ago. Now we're at 22% and a little bit above that, because this ends in 2000, at the end of January of this year. Over the same 3-year period, the volatility went from 42% to 60% of the day-ahead market. In the real-time market, that orange line, it went from 50% to 100%. How many people are dispatching to those real-time prices and thinking about it? And where's the value? I mean, you look at a battery, you look at Wärtsilä and GE are here, they have technologies that address that real-time price. How can we capture that value? Is it just limited to California? That'll show in a minute. No, and it's not just limited to Texas either. Heterogeneity of prices in terms of where the volatility is, it matters a bit. This is actually a 2-year-old volatility map. There's been a little shift over the last few years to Southern California having, I don't think you can find a node with a standard deviation price in the real time less than $50 a megawatt hour. So it's just volatile. James Barner, I know you're not in the ISO. Maybe this might be a good, he's with LADWP, presented yesterday. There's a lot of volatility when you in that market. It's a good thing and a bad thing. If you have flexible resources or you're gearing yourself up to adapt towards the flexibility, there's an opportunity there. And it's something to consider. Everything's very spatially defined in California. The volatility is a function of renewables largely, the intermittency driven by renewables. What's interesting is how this manifests itself in terms of real-time prices and the pattern of those prices through time. So this is a frequency plot. Each click of a price above $100 a megawatt hour, we consider a spike. And those spikes are registered here. And that's the count on the y-axis. So we have a count for each of the 12 months of the year. This is 2016 data. And what we're seeing is for Q1 and Q4, almost a relatively uniform pattern, particularly first 3 months of the year and the last 2 months of the year. It's almost flat. It doesn't matter what time of day. As we get to Q3, we see, particularly the month of August and September, we see a concentration effect during the hours of, well, when the sun's setting effectively, hours 16 to 22. There's a lot of demand and the prices are more volatile. That's interesting. What's going to happen in the future? We're going to have more price spikes, I can tell you that, because volatility is increasing as a function of renewables. That's pretty clear. Batteries might be there to help in certain locations mitigate a small dimension of this. But when you're transforming your power supply from 7% to 50% renewables, you need a lot of batteries to dampen that out, a lot more than is being added or planned to be added. And I think Mark Dyson just commented the same thing. It's just, there's just too much coming too quickly. So there's an opportunity there. And it also presents an opportunity in working with customers as well. I mean, avoiding a price spike of $1,000 a megawatt hour, hot water heaters, they're there. That's a storage unit. So these Internet of Things spells some potential. But what we're thinking of is, how do I take my existing resources or look at some new resources and take advantage of this? If batteries are good at regulation and they're good at price spikes, is there some advantage to using them for both, or internal combustion engines, using them for both? And the answer is yes. And the reason we were looking at California and then Texas is they're a harbinger of things to come across this country. And I think during the pre-conference workshop, we spent a fair bit of time on the work that we've done in Hawaii, which is a real harbinger of things to come. They're already in significant dump energy conditions, and they haven't approached 50% renewables. Price spikes here on the left axis is the probability of a price spike as a function of renewables on the x-axis. And same thing, spikes are clearly driven by renewable generation, something you just can't ignore. So let's look at the same thing for ERCOT. ERCOT's a bit different. ERCOT has a lot of wind data. It has a lot of data, it also has a lot of wind generation, moreover. And that results in a different pattern. We don't have prices dropping out at the moment during the super peak hours. We know that because we look at the Y2 axis, we see the implied heat rates. And they're increasing during the traditional peak hours, 15, 16, just where you'd expect them. The solar energy isn't there, it isn't concentrated, so we don't have the shift to the late afternoon hours that we do in California. But what we see is the same pattern. The average price has declined, so it's declining average prices. It's gone from $40 in 2014 to $24 in 2016. Renewables have no costs. They're able to come in and undercut, and frankly, $24 a megawatt hour. In most of Texas, if you're to be able to receive that for a wind facility, you're in the money. That's a good thing. In terms of renewables driving prices, what we see is the renewable penetration rate increases above 40%. The day ahead prices drop. And as renewables back off and there's less generation, prices rise. There's a lot of variability here. And we talk about meaningful uncertainty. We talk about probabilistically enveloping those future states. I think that range in prices as a function of renewables being the key driver is really worth capturing. And that's what our models are gearing up to do. Not only as we do it today in the hourly market, we're also doing it now in the 5-minute markets. If we look at Texas, further, the same dynamic of there's a lot of variability, but it's different than California. California is just volatile almost everywhere you go, particularly the southern half of the state. Texas, the concentration and volatility traditionally has been in West Texas. Excuse me. Has been in West Texas. They've been building transmission. That's actually been mitigated a little bit, but it's a volatile market. And the issue is storage going to come in and save the day in Texas? Well, nobody's doing it yet. If the prices continue to drop in storage, there's some opportunity there. Volatility is interesting. Let's look at the same thing for Texas. As renewables increase, the probability of price spikes is even greater. And there's more potential in Texas. There's more volatility as a whole in Texas than in California as a whole. But California's catching up in that regard. And I'd say their price caps are the only thing that's really limiting them from catching up to Texas. Texas has a price cap of now $9,000 a megawatt hour. And it's this shift in the supply stack to the right. It's that flat supply curve. But when renewables drop off in West Texas and now the Corpus Christi area with some wind projects, you hit price spikes. So you immediately hit that vertical wall of supply. And it's not that it costs on average a lot to generate, it's that there's startup costs and there's a value for being flexible. And that flexibility premium is garnished in the real-time market. And that's something that's continuing to increase as renewables over the last 4 years have gone from 10% to 15%, while the volatility's gone in the day-ahead market from 25 to 55%. In the real time, it's gone from 100 to 200%. 200%, that's a lot of Texas giddy up in price. And that's something that, we sit here today. How does that impact decision analysis? How are you going to take advantage of these prices? How are you going to deal with the lower average price? It's a tough condition, and thinking about what tools are in place and how management has to change their thinking. It's not about the average. It's not about having energy from your resources to meet your load. It's not that at all. You can buy from the market. It's there all the time. It's, do you have enough flexible resources to insulate your customers against the variability in prices? Have you been able to adapt to this new paradigm? Jobs versus, or Apple versus Nokia. West Texas, doesn't this look a lot like California? And this is West Texas. It's pretty much uniform during Q1 in November and December. There's a lot of concentration. Price spike frequency is in the hours, late afternoon, when people come home and turn up their AC. Just what it looks like in California. And it's not driven by the sun. It's all by wind. And wind generally blows in the off-peak. So there's a difference in the market fundamentals, but the same underlying load dynamics are still driving the volatility and price dynamics. And in South Texas, not as volatile as West Texas, but still a lot of volatility. And this suggests some opportunities. Allison Weiss today talked about batteries, and batteries taking advantage of these price spikes. You don't need to be running a flexible resource all hours a day, only when you have a high probability of gaining some, let's call it, scarcity rents for flexibility during those hours where there's a high frequency event. Otherwise, use a flexible resource to provide regulation or some other ancillary services. That makes sense. If we look at the causes of real-time price spikes for Texas, there are two big components. One is congestion, which is shown in green on this graph here. The other is imbalances in the real-time energy market. Forecasted prices are different than, or forecasted conditions are different than realized conditions. So there's also a dimension of convergence when they use these models to come up with the day-ahead settlements. They're having to make assumptions and have a tolerance level to get them to run in 5 minutes. So you have inevitably some issues, and there's an imbalance as a result. We see negative prices also in Texas. They're more volatile than California, and I showed you California. And those negative prices are just a result of imbalances and forecast error. All right, I'm down to the last few minutes here. Let's think about how we can take further advantage of this. There's this day-ahead real-time spread. It exists in Texas, it exists in California, it exists to a lesser, 10% in Texas, roughly 6.5%, growing to about, actually lately, 8% in California. And it's pretty large in SPP, but as you go further east, it almost dissipates to 1%. The reason that there's a spread where the day-ahead price is greater than the real-time price is simple. There's risk if you let everything ride in the real-time market. So most people have policies that say, don't do that. We don't want to get wiped out by a price spike. Fair enough. If you're short power, you don't want to do that. And if you're long power, you're happy to take the spike if you can. So there's just an imbalance between buyers and sellers. Bottom line is there's a spread, though. If you have a renewable resource and you're getting 10% less because you're stuck with the real-time prices, maybe the flexible resource, batteries plus solar, makes sense. You don't need much. You just need to be there enough to absorb some 5-minute price spikes, short duration, high capacity batteries. So spreads exist. They tend to exist where there's a lot of renewable generation as well. And it's something that can be taken advantage of, whether it's positive or negative. A highly flexible resource is certainly able to capture and leverage the value out of a day-ahead real-time spread. And any renewable asset, depending on its location, can have a lot of value that can be extracted from capturing the day-ahead real-time spread. What causes the spread? It's pretty much the same thing that causes price spikes. It's renewable generation causing an imbalance that's not anticipated, congestion, and a little bit of load, forecast error. If we look at Texas, let's look at this real-time conditions. We have wind generation in a particular region in Texas on the x-axis and real-time prices on the y-axis. And what we're seeing is the wind generation backs off, prices, particularly spikes, occur, just as you'd expect. How does this translate into looking at a project? Do we look at the day-ahead prices? Do we look at the hourly prices? Or should we be looking at the real-time prices? And if we look at the real-time prices, which is what the asset receives, do we look at it correlated with the actual prices? So this is done for a project in Texas. And it happened to be it's a wind farm, as you might have guessed. The day-ahead real-time price difference at the node was 5%. The expectation of revenue difference was 13%. So the day-ahead revenue was 13% greater than the real-time, but the price difference was 5%. Does anybody know why? Why? I'd have go ahead.
Typically, when the wind is producing more, the price is lower. So when that unit is producing more, it's getting less revenue.
Thanks, Mike. Exactly right. So when it's blowing, you remember this slide before, when it's blowing, prices are low. When it's not, prices are high, thus the 13% difference. And that's what you'd expect. But what does this mean from a modeling perspective? It means that we need to begin accounting for real-time prices when we start valuing renewable projects and this new dynamic, because renewables receive the real-time. They don't get the day ahead. It's an eye-opener for most folks. Everybody I know in planning looks at day-ahead prices at best. They like monthly blocks, better yet. But this is saying, no, we have to go down further into these 5-minute conditions. So there are some decision analysis implications, and I just want to get to them in summary. So weather's driving renewables and load, and thus market prices in the real-time market. And you need to capture the variability in weather and its impact on system renewables and LMP prices, and your load as well. When we deal with this issue of structural change, what's the roadmap? So it's arrived. It's in the West, Texas, SPP, and sections of MISO. And it's progressing very rapidly east. There's no question about it. Modeling on average prices is out. You need to match the volatility in prices in the day-ahead market and the real-time markets. You need to start capturing the real-time price dynamics and those spikes, both positive and negative. We've been looking at this with regime switching models, and now we switched to something called Fourier analysis models, where we're able to capture the real-time price dynamics and match those histograms of price spikes. Weather matters. Weather drives system demand, it drives generation. So we have not only load, but now supply as a function of weather. And that extra variability of weather is something that we need to account for. So it's a fundamental driver like gas prices, but only more important now. And a model that doesn't capture the variability in weather is going to miss out on the price dynamics of today's market. Flexibility matters and timing. It's not about the average conditions and normalized load and normalized prices. You can't use shapes anymore. The shapes have to be dynamic as a function of weather. And those are the new conditions that we need to reposition our thinking for in order to adapt to this structural change. Okay, I'm 3 minutes negative, I hear, and you've all been here for a day and a half, but I'll take any questions. Go ahead.
You've done any
Gee.
economic analysis with the cost of storage to see if whether it's 6% or 13% premium pays for the storage?
Good question. So storage will earn typically, Jane, about day ahead real time will add about 10% extra to a storage facility, depending on where it is, somewhere between 0 and 10%. Still, typically, a large portion of the revenue, 50%, typically will be garnished through ancillary services, and the balance of 40% will be from real-time price spikes. That's what Allison showed earlier today, Allison Weiss of Ascend, and that's what our models consistently show. I mean, there's variance, obviously, in those numbers. Those are good rules of thumb. But taking advantage of real-time price spikes is a great idea. That's what these assets are built for. Storage works better where ISO rules are well adapted towards storage, like New York, which has fantastic rules, I'd say, for storage relative to, let's say, SPP.
Have you seen or done any analysis where you evaluated the changes in bidding behavior as a result of dark spreads?
Are there changes in bidding behavior as a result of day-ahead real-time spreads? I think there are, the renewable projects are stuck. They just get the real time. And so the question really, if I could just take it a step further, is are there some market entities out there, day-ahead real-time traders, for example, that are taking advantage of the day-ahead real-time spread? Yes. And are they growing in size? Not adding more, but their pots are growing larger. And they're in a little bit of a lull right now. Almost all of them are in Puerto Rico. So they're probably offline today. But they'll be in business shortly, I think. There's about a dozen firms in Puerto Rico that do this. There's been, over the last 3 years, I think they've added about 3 firms in Puerto Rico to do this. And the reason they all exist in Puerto Rico is tax advantages, by the way.
As you're layering on more batteries, that seems like that would take some volatility off of the system. So with that, is that something to like bring the day ahead and real-time prices them closer together and make that less of a problem?
So are batteries going to solve the dimension of intermittency of renewables and smooth it out so it looks like the day-ahead price effectively? And it's going to eliminate the price spikes. If you sit in the control room at Duke, where you're at, and you'll see clouds come over, and you'll see a drop of a couple thousand megawatts of gen like that. That's a lot of batteries, 2,000 megawatt hours, to be there at that moment. And that's where you are today. That number's doubling to 4, 6, 8,000 megawatt hours, and you're going to have the same swings. So that's why the batteries just aren't being installed at the rate that we're seeing renewables growth. Now there is some potential with solar teamed up with batteries and new projects, the peaking plants of tomorrow that have been referred to earlier. But in terms of batteries stepping in and mitigating the market price volatilities, we're a long ways off from that. There's more volatility ahead, and that trend's going to continue. All right. Well, thank you.